Hello and welcome to ET Now. You're watching Outlook 2026 and we have today with us Nilkanth Mishra, who is the Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Nilkanth, thank you very much for joining us on ET Now. To begin with, Nilkanth, you are pegging a growth of over 7% in FY27 and you're saying that the monetary easing is something which will be pushing growth to beyond 7% for the next financial year. Take us through your assessment of how growth is going to pan out from here on.
So we are talking about 7.5% growth in FY27. And in order to understand what's going to happen next year, it's important to understand what happened in the previous fiscal year, which is FY25. So we had 6.5% GDP growth, real GDP growth, despite 130 basis points of fiscal consolidation and monetary tightening, which resulted in credit growth declining. And a lot of this monetary tightening was not just interest rates, it was also the loan deposit ratio, letters sent to banks, etc., which led to credit growth shrinking and therefore being a 2% point plus of GDP growth being taken off. So we grew at 6.5 despite monetary and fiscal tightening. In FY26, which is this fiscal year, the monetary tightening, of course, faded because the monetary policies were eased. It is still not a tailwind because it takes time for banks and borrowers to become comfortable lending when coming out of a down cycle. The fiscal headwinds eased. So instead of 130 basis points, you only had a 40 basis point explicit, and towards the end of the year, you also had some amount of GST cut stimulus. In FY27, the explicit fiscal tightening does not need to be more than 20 basis points. So we are, in our report, we have flagged 4.2, but frankly, that's something we'll discover when the government announces its budget in February. The monetary can actually become a tailwind. So it's like class 3, class 4 maths, right? That if an aircraft is on the ground speed is 700 kilometers an hour, and there are headwinds of 250 kilometers an hour, if the headwinds fade to 100 kilometers an hour, what will the aircraft fly at? It's 850, right? So that's the simple math. If one of them become tailwind, then can it grow faster? It will. And that's the reason why we think that growth next year can actually be 7.5% in real terms.
Now, you said, we have seen monetary easing happening on nearly 120 pips, 25 bips of easing which has come in. What is the kind of easing that you're looking at for calendar year 2026?
So, so I'll answer this in two parts. The first is the channels through which monetary easing works. So there are 4 channels in theory. 2 of them don't work. So the asset price channel and the currency channel in India are not very effective. So the 2 channels that do work are the rates channel and the credit risk channel. So what I mean by that is that if there is a certain demand for loans at 8.5%, if you bring it down to 7.5%, then there'll be more demand for loans. That in effect is less potent in India than it would be if, say, you were going from 3% to 2% in some of the developed markets. And given that many of the NBFCs, which are actually driving the new to credit business, they are operating at 18-20%. The 1% here or there doesn't really make much of a difference. So it's an important channel, but not a very potent channel. The most potent channel in India, like in other markets, is the credit risk channel. That once the central bank shows that we are in an easing cycle and that growth is likely to revive, the lenders and the borrowers become much more comfortable with loans. And that takes time, which is why there is a lead lag. Given that the central bank, the regulator in India, has very clearly indicated that that they want that the growth is below aspirations. So we are now starting to see risk appetite build up in the borrowers and the lenders. And the efficacy of the cut so far, resulting in higher credit growth, is only something that is in the future. It's not yet fully visible. We rebounded a bit, but quite a bit, maybe just share gains from the bond market. On the second part of that question is, have rates fully transmitted across all durations? So, for example, is it enough that the deposit rates have come down by a similar amount as the repo rate cuts, or have longer term yields normalized. And India still has a very steep yield curve. This is another point that we make in our report, that the 10-year bond yield is still too high at 6.6. We think that it can fall by 50 basis points without any further rate cuts from the MPC. And there are two big drivers of that. The first is that the government's issuance itself is distorting the yield curve. So, in the last 1.5, 2 years, so from Jan 24 to now, the outstanding T-bills are now are down by 2.4 trillion rupees. There's many reasons for that, but as the government starts increasing that issuance, and they should, the issuance of G-Secs can come down. So from a pure demand supply perspective, that can change. But equally importantly, the duration of bonds issued, so the outstanding stock or the weighted average maturity of outstanding stock of central government debt is now 13.2 years. It used to be less than 10 years, about 10 years back. In the US, it is 6 years. Incrementally, in the last 1.5 years, the issuance maturity is 20, 21 years. So once you normalize that, the yield curve becomes less steep. We also think that the demand supply will be much more amenable to yields falling. And so you can have medium to long-term rates coming down either through better signaling, and that's the last point I would like to make. Sorry, this is a long answer, but there is significant slack in the economy, and that is most visible in the labor markets. That is where the slack tends to be most inflationary or disinflationary. We think that the economy is 5 to 11% below its pre-pandemic path, at the low end 5 and upper end 11. And which means that you can run the economy faster than trend growth for several years before sticky inflationary pressures start building up. And which means that the current market expectation that rate hikes will restart in 1.5, 2 years is something that is completely inappropriate. So as this plays out through the year, we think that longer term rates will come down, and that's the monetary easing I was talking about.
Okay, if you can also give us a sense of the growth. You penciled in 7.5% growth, but one of the concerns is the nominal growth rate, which is sub 10% as of now. How do you see that moving up? Because many of your targets, whether it's a fiscal deficit or for that matter tax collection, is based on the nominal growth. So how do you see that nominal growth moving up to about 10%?
So the first signs of that were visible in the November inflation data itself. So when you look at food inflation and plot, say, the April to also May to November, and then December to May inflation trends, last year the May to November was a complete outlier, meaning the most significant decline in food prices ever seen. And clearly now food inflation as a if you measure the deviation from core inflation and headline, it moves in a band, but it is absolutely at the lowest level of the band. So food inflation from here should rise. Whether disinflation will result in very supremely high inflation or not, time will tell. But as of now, further disinflation is extremely unlikely. On the core side, as I said earlier, there is significant slack in the economy, so it's very hard to see core inflation shooting up from where we are. There should be some normalization as the economy sort of normalizes and starts running slightly higher than trend. And therefore, I would say that 3.5% is a reasonable number to work with. I think running with a 1.5, 2% deflator is maybe inappropriate for next year. And therefore, a 10.5, 11% number for nominal GDP is a reasonable number to work with for FY27. There's another aspect to nominal GDP which affects us in the markets, which is that company profit growth, the top line revenue growth. all of them get affected by that, and which again is one of the reasons why we think that 12-month earnings will do much better in CY26 than it did in CY25.
Interesting, you spoke about inflation, Nilkanth. If you look at the inflation numbers, gold has been one of the reasons for inflation numbers there. But, the rise in gold has been compensated by the muted oil prices which are there. How do you see these two commodities playing out in 2026? Do you see gold run to continue, and do you see oil prices to be remain in a subdued?
Right. So for gold and silver, both see there is an inflation impact, and then there is a balance of payments impact. So on the balance of payments impact, I totally agree with you. They kind of cancel each other out. So dollar per barrel is about $1.8 billion a year. And if oil prices are down $10 a barrel, which means that there is a $17-18 billion balance of payment gain or terms of trade improvement for India. On the gold side, normally if prices are, well, normal times where gold prices go up 50%, but whenever gold prices would rise by a very large quantum, the demand for gold, volume of gold imported would fall because households in India mostly by value of gold. That some nephew's wedding, I want to give 30,000 rupees. You don't really count the grammage. But that adjustment has not happened this time. And I think this is perhaps the first upcycle where the average net worth of Indians is now much better. And therefore, AUMs of gold ETFs, all of those are starting to rise. And therefore, speculative demand for gold, investor demand for gold is much stronger than it used to be. So household demand tends to be counter-cyclical in terms of prices. So if prices go up, volume goes down. The investor demand for gold and silver is pro-cyclical. Prices go up, volumes go up. So in our estimate, there's about another $16 to $18 billion extra on the balance of. So oil and gold kind of cancel each other out. Where will these two be next year? Our expectation is, at least my expectation is that gold prices may be slightly higher, but the vicious part of the upswing may be done. Silver is still going through that speculative upturn. You never know when it ends, but whenever it ends, as someone was flagging that if you had bought silver at the peak 25, 30 years back, you would have been now come back to par. So on the oil side, it is reasonable to expect that prices may remain at these levels, if not lower. Forward gas prices are suggesting that prices will come down. If the Russia-Ukraine war ends, I think that's also quite supportive of lower energy prices, which I think will be quite favorable to India's balance of payments. But on the inflation side, so while on the balance of payment side, these two are kind of equally important, but on the opposite sides, cancel each other out. On the inflation side, the retail price of petrol and diesel hasn't really changed too much, and the negative aspect of lower energy prices is mostly indirect through plastics, etc., packaging material, and some of the processed items. Gold and silver are directly impacting a lot of the inflation, not just here, but also in China, which is why we look at median inflation. So academic research shows that median inflation is the most appropriate measure of economic slack or the signs of whether the economy is overheating or cooling. And adjusted for that, so pure demand side inflation is actually much lower in India. And that is what is giving us confidence that there is slack in the economy and we can run faster than trend growth without causing a lot of inflationary pressure. So on both of these, the headline may get affected a bit, but perhaps what monetary policy needs to respond to is sustained sticky inflationary pressures, and we don't think they will reach a level which warrant tightening.
Nilkanth, I want to, now get into the earnings outlook which you have come out with. We started the year with a lot of downgrades. Q1 was a bad quarter. Q2 we saw improvement in earnings, and now we are started to see some kind of upgrades coming in. As we go into next financial year, how do you see earnings take off from here?
So the what matters to the market is the 12-month forward earnings. As you would realize, the 12-month forward earnings have two parts. One is the roll forward. So every 3 months, you're getting 3 more months of the next financial year. And the second is the pace of cuts. So our FY27, 28 earnings falling or rising would be very important as we think about forward earnings going forward. And in the last 12 months, post-COVID, we had a very steep upward curve for 12-month forward earnings. In the last 12 months, it flattened out. So we had 12 consecutive months of earnings downgrades. And we saw almost all of the roll forward gains being offset by the pace of cuts. November was the first month where we actually, so October, the pace of cuts slowed to a trickle. And November was when we actually saw the first upgrade in a while. And our expectation is that the pace of cuts slows sharply because the economic momentum is no longer decelerating, and it is picking up. And therefore, the necessity for further cuts is actually quite low. And we are forecasting a 14% growth in 12-month forward earnings in CY26. This is also, we double-checked because, generally the economy and the markets are synced on a 5-10 year basis, but not necessarily every year. And therefore, it's very important for us to also look at sector by sector as to which are the sectors which caused the deceleration, the pace of cuts to accelerate, and which are the sectors where growth can actually support earnings in the next 12 months. So 2/3 of the earnings actually come from four sectors: financials, energy, IT, and industrials. This set was very different 10 years back, but this is the current set. And in our view, if credit growth is accelerating, we are seeing so much of strategic investment that is starting to happen. Of course, that's for the longer term, but we are seeing a rebound. The policy is very supportive of credit growth. And as the economy is rebounding, the risk of large NPAs emerging as a shock is very low. So that's supportive. On the energy side, given where the current consensus is, the risk of a significant downgrade appears very low. Same with IT, that we're talking about 7 to 8% growth. I don't think these are high growth sectors, but those estimates are quite defensible, especially as the average rupee itself will be a lot lower in FY27 because we've seen a lot of deceleration or depreciation in the last 3-4 months. And on the industrial side, we expect that as economic momentum starts to get clearer to corporates, we expect that the execution of some of the pipelines. So the order books have grown very nicely. I think revenue growth is also going to be quite decent. So when you look at these sectors, it gives you a lot of comfort on the reliability of earnings. And therefore, if forward earnings do deliver 14% growth, I think the markets as well as the currency may actually be reasonably well supported, because that may actually slow down the pace of FI outflows, may even bring in some FI inflows next year.
Interesting. We had triple cuts, which had we had a income tax cut, then we had the monetary easing or the interest rate cuts, and then the GST cut. And one would have imagined that these cuts would have driven the consumption-led sectors. But you are saying that it will be investment-led sectors which will outperform the consumption-led sectors. Why do you say so?
See, when we talk about economic slack, most people quickly start looking at the Obicus survey on industry utilization or power sector utilization or cement or steel sector utilization. The most important part of economic slack is in the labor market. So India is the only large economy where the workforce is expanding rapidly. And if you are 5 to 11% below the pre-pandemic path, you have significant slack in the labor market, which is why real wage growth is a problem, which is why you are seeing weak consumption trends at the lower end of the consumption basket. And I don't think that is going to change very quickly because, as I explained earlier, there is significant slack in the economy, and the economy needs to run faster than trend for a while before it can close that labor market slack. I also disagree with this characterization that the government gave a lot of stimulus. See, the government's tax cut in this fiscal year was, of course, very significant, but the fiscal deficit was still falling. So the government's impact on aggregate demand is through the fiscal deficit itself. So if 4.8 goes to 4.4, that means that the government is a drag on aggregate demand for the right reasons. I'm very supportive, and I think the government may need to do more to bring long-term cost of capital down even further. But it would be important to understand the impact of that on the economy. And despite this 1 lakh crore cut, the tax collection, personal income tax collection budgeted, I think they're missing it this year, but that number was still 14%, which is faster than nominal GDP growth. And the investment to GDP ratio was flat, which means that if the government is a drag on aggregate demand and investment to GDP ratio is flat, which means that whatever is non-investment is actually slowing. So from a government perspective, for sure, I don't think, so the GST cuts, yes, I think that's a positive, and we have seen that car sales have done well. A large part of that 1.6, 1.7 lakh crores actually went into cars and therefore autos in general. And we have seen those numbers do well. And I don't see next year also the slack really in the labor market really coming off. And that's the reason to expect that investments will still do better because the real estate market is turning up. The power generation cycle, capex is turning up. Those are the sectors which really drive a lot of investment momentum.
One of the arguments made by investors is the high valuation that the Indian markets have, especially with respect to price to earnings. We've been able to sustain high value price to earnings, and despite that, we have seen a lot of outflows foreign outflows happening, which could be in form of FDI, private equity exiting, or many of the foreign investors cashing out from the market there. How do you see India's valuation metrics moving from here on? We are still a premium, but much lower than a 10-year one, and the premium against developed markets have also come down. But we have gone through a time correction as well in that sense. How do you see India's valuation?
See, the valuations are still quite high, meaning that price to earnings multiples are elevated. But the metrics, you very rightly said, you can look at your own history or you can look at it in comparison to other markets because no financial asset class lives in isolation. So people will look at alternatives. And so versus the rest of the world, I also agree that the price to earnings premium has come off, and that makes India relatively more attractive. But that's generally more true for foreign firms than for Indian investors. Versus its own history, also the PE multiples are elevated. But just because they're elevated, to assume that they will fall sharply is also perhaps not appropriate. We are currently seeing, and we put this number in our report, about 6.5 to 7 trillion rupees of demand for equities, and the annual, that is. And if the supply of equities, which is IPOs and QIPs and block sales, is less than that, then the P multiples can actually go up. But we are currently at this finely balanced state where if the P multiples go up, I expect that supply of equity will also go up. And if P multiples come down, then I think the supply sort of pulls out. And we have seen that once in March this year, where when the market fell off, the the IPOs just dried up. So that is a fairly supportive dynamic or phenomenon for PE multiples. And therefore, a lot of the underlying growth in headline indices could actually come from the EPS, the 12-month forward EPS going up from here. And that we are reasonably confident should improve in CY26.
Given that you are favoring investment over consumption, what are the sectors where you are underweight, and which are the sectors where you are overweight?
So we are overweight on financials, on several of the construction proxies. We're also marginally overweight IT now. We've been underweight for a while, but the sector has been beaten down quite a bit, and we think it's not cheap, very cheap now, but at least worth a trade. On the underweight side, so we have the staples, we have pharmaceuticals, healthcare, basically very expensive, and also metals, where we think that if price of energy is coming down, several other metals will actually underperform.
Nilkanth, it was a pleasure talking to you today and getting a perspective of how 2026 is going to look from an economy point of view and from a markets point of view. Thank you very much for joining us today in Outlook 2026.
Thank you, Sangeeta.